Okay, so welcome to this crash course to help you pass for your life and health license. This is going to be a few hours. We're going to try to be in depth as possible. So you probably have already finished your pre-licensing course if your state required one. And so this is in conjunction with that to help you pass. Now, I will just give you a few tips. This should help you pass. Take good notes, but really the preparation to make sure you nail it and pass that test is going to be the exam simulators. So if you took Excel as your pre-licensing course, then there at the end of the course there is a little like end of like a chapter review or like a final exam. Once you finish that final exam, it opens up three simulators. Okay. These are three practice tests that you're going to want to do over and over and over again. If you get 85% on all three simulators, you will pass. Do not take your test unless you get 85s on all three of the simulators. 90 is actually way better. But so how this thing works is some states require a pre-licensing thing. You can run through that as fast as you can to complete it. I mean, you literally could be cooking dinner with that little earbud in and on that course. Just get it through it as quickly as you can, and then open up those simulators and then take the simulators over and over in a cramming style so that you go from like 30% to 50% to 90%. Okay. That's what's going to help you to make sure you're fully prepared and confident to take your test. So today is a few hours at least going through all of the just review of everything. And if there's one area or two areas that you really are weak in, you maybe want to go back into the course and just go through this stuff. So I'm going to go through first a little just helping you understand concepts, different concepts that if you understand these, then you'll understand a lot of the test. If you've been going through the course or you've been going through the simulators or the practice tests, maybe you're finding that you're getting answers right, but you're not really still understanding the concepts. So this course should help you with that. But I'm going to do a little bit of cramming first. First, I want to introduce Russ Kobrin. So my name is Jaime Villalovos. This is Russ Kobrin. He's going to be going through a lot of the tangible stuff to help you that you're going to probably want to know about to pass your test. So let's start first with this little basic cram of the concepts, especially the concepts around whole life insurance. Okay, I'm going to teach you some of the basic concepts around life insurance. And again, if you understand these basic concepts, then you'll be able to answer a lot of the questions on the test. Most of the questions on the tests are dealing with whole life. Okay, so actually, before I even show you that, let's show you term insurance versus permanent insurance. Term is temporary, so it can go for 10 years, 20 years, 30 years, and then permanent is, it's for until you die. Okay. So think of term as kind of like almost like auto insurance. Like you have to get in a car accident before it pays out. Well, term insurance, you have to die, obviously, before it pays out. Where permanent insurance has other uses. Okay. So there's different kinds of term. And I'll just kind of show you this visually. And then Russ will go into more details on some of these things. But so term insurance, the most common one that you've heard is called level term. Okay. And let's say it's 20 years. Okay. And let's call it $45 a month. All right. So you're paying $45 a month for 20 years and it's level term. So let's say it's $300,000 of death benefit. The face amount of the life insurance policy or death benefit is $300,000. So if you die, you get $300,000. So you're paying $45 a month for 20 years. If you die, you get $300,000. It's all level. But there's this other version of life insurance, and I want you to understand this concept. This is increasing term or annual renewable term, and it increases. Okay, increasing. So instead of being $45 a month, it may start off at like 20 and then end at like 58 or something. Okay. Still for the same 20 years, still the same $300,000 of death benefit. So how this works is actually how insurance really works. It's based on your age.
the price per unit of insurance goes up based on your age. So in the early years, you are right, you're underpaying to like, right, sorry, you're overpaying in the early years to underpay in the later years. So what they're essentially doing on this level term is just averaging out so that you pay the same amount the whole time. But this is really how the cost of the insurance works. There's another one called decreasing term, and this will definitely be on your test. Decreasing term. Okay. So decreasing term is typically for 30 years. Not very popular anymore, but how it would work is, let's say your face amount started off at the 300,000, but it decreases over time. So let's say you're paying the same amount of money every month, but over time your face amount decreases. So let me explain. So let's say you died here, you get 300,000. If you died here, maybe you only got 200,000. If you died here closer to the 30 years, maybe you only get 50,000. So this was popular for mortgage. So let's say I bought a new home, I have a new 30-year mortgage, and I need life insurance to protect my family, but I can't afford it because I have this big mortgage now. So I buy an inexpensive decreasing term and it mirrors the mortgage. So your test question will be, what insurance mirrors the mortgage? If you see anything about mortgage, just remember decreasing term. It mirrors the mortgage. Okay. So now you understand the basics of term insurance. Annual renewable or increasing term, it goes up based on your age every year a little bit. It doesn't change if your health changes. Your health is set from the time that you apply for the policy, but it goes up based on your age. And then you have your level term, which is the most popular, 20 years level term or something where it stays the same. And then you have your decreasing. Now, this is the big one that I want you to understand the concept, that whole life policy. So think of whole life. They call it whole life because you pay for your whole life. It's an easy way to remember it. It's permanent. Okay. And basically, there's two components now. You have your life insurance component, but you also have another component called cash value. Cash value is just a fancy word for savings account. So instead of being $45 a month for that same 300,000, your premium is what you pay every month for your insurance policy. It's higher because it's permanent. Term insurance is very unlikely to ever even pay out because you're not going to die probably in the next 20 years. You die when you're much older, when you're right, when you're hopefully of old age. And so the term insurance, that 20 years or that 30 years has already expired. You no longer have the insurance. That's why the permanent policies are more popular for a lot of people because they actually want the life insurance when they need it, when they die. But because it's permanent, the costs, the premiums are a little higher. So let's say instead of the $45 a month, now it's $245 a month. Okay. So of your premium, part of it goes to pay for the cost of insurance for your $300,000 face amount or death benefit. And then the rest of it goes into this savings account. In a whole life policy, typically the savings account will earn like 4 to 6%. Okay. Okay. Now I want you to understand how this works though. All right. So how it works is you're putting your money in and and the cash value is building up until endowment. Endowment is going to be on your test. The word endowment happens at 100 years old. Okay, when you're 100 years old. So what endowment means is that your cash value dollars, that amount of money equals your face amount. Your cash value equals your face amount. See how it comes together here? Boom, it meets that. All right. So let me just kind of back up a little bit here. So make it a little cleaner. Okay. So you understand how all this works. Okay. Now I'm putting in my money into my life insurance policy. And let's say I die early here. I get 300,000 death benefit. But if I die here, I still get 300,000, but 150,000 came from my death benefit and 150,000 came from my cash value. If I died here closer to 100, I'm still getting my 300,000, but really I'm just getting my cash value back. Okay. So if I covered up this, what does this look like? This one right here, this little triangle. It means that you're paying the same amount of money every month, but getting less coverage from the insurance company. So to me, it looks like that. Remember that annual renewable term, that increasing term? And that's why I want you to understand this concept that all insurance works the same. It goes up based on your age every month. Okay. Now let's try to clean this up a little. um, so that again, you can understand it. Okay. All right. Okay. So I'm putting my money in every month into this policy. And if I die, I get 300,000. The things about the whole life policy, it's very, it's not flexible. So if you ever missed a premium payment of the $245, it would cancel. And that would be what's called surrender. Think of surrender as I surrender, I give up. You're giving up your policy. You no longer have a policy. So it's not flexible. If you can't make a premium payment, it goes into surrender mode. Okay. Also, where it's not flexible is you only get your face amount, not really both. So, for example, if I borrowed money from my cash value, let's say I borrowed 50,000 from my cash value and I died, I would then only get 250,000. Okay. So, whole life, you understand the concept right now of how that works. So, you understand endowment at age 100. Okay. There's a couple other policies that are permanent. One is called universal. Okay. The term universal means flexible. So if you see something about flexible premiums on your test, it's universal. Okay. Because how that works is unlike the whole life, if you miss a premium payment, let's say you have this universal policy. If you miss a premium payment of that $245, you can't make it because maybe you're laid off, you can take money out of your cash value and pay the premiums for the life insurance that month. Not then it wouldn't result in a surrender. You'd still have your policy in force. The other thing, it has a tax corridor basically. So if your cash value starts to grow and it's getting close to that 300,000, your face amount, your death benefit will increase. So you can essentially get your death benefit plus cash value if you die. Okay. So it's a little bit more flexible in that universal plan. Universal, flexible. That will be on your test. Okay. Then there's one called a variable universal life. So there's index universal life, which is indexed. There's UL, which is flexible. So if you think of UL, universal life, it means flexible. But the index just means that instead of the 4 to 6% general account, it's in a index, kind of like S&P 500 or something like that. If you see the term variable, that's when it's hooked to like mirroring mutual funds or something that's in the stock market. It means that it is a variable product, a securities product that you could lose money potentially if the market went down. So if you see anything about a life insurance policy that has stock market or mutual funds or mirroring the stock market or mirroring mutual funds, look for the term variable. That's your answer. Okay, pretty simple. All right. All right. Now, when you have these permanent policies and you surrender, remember the term surrender means you give up, means you cancel early before you are dead. You have cash in there. Term policies do not accumulate cash. So term policies are just pure term insurance for 20 years or 30 years or however long the term is. And if, again, you need to cancel, you just cancel and they keep all of your money. You don't get any money unless you die. Okay. So, but in these permanent ones, you have cash in there. So what happens to that cash if you cancel? So let's say you had, again, that policy and there was, $50,000 worth of your cash in there. And now you don't want the policy anymore. You can't pay it anymore. What happens upon surrender? Okay, well, there's this thing called surrender options. And this will for sure be on your test. So there's 3 options here that I want you to know about. First of all, option 1, you can just take the cash. You can take it in cash. Now, you're going to have to probably pay taxes because this cash value is growing tax deferred and you never pay taxes. So you probably will have a tax penalty. And you will also probably have some fees or penalties, okay, when you surrender. So after your penalties and fees, your surrender penalties and stuff, then you can take the rest, whatever's left over of your 50,000 in cash. Then there's two other options. Okay, one's called reduced paid up, and I'm going to give you some ways to remember this. Reduced paid up, and also extended term. Now, those might maybe seem hard to remember, okay, but it's actually pretty easy. So let's say again you had that policy for $300,000 of life insurance. That's, you wanted the life insurance, but you can't afford to pay it anymore. You lost your job or whatever happened and you have to cancel it, but you have that cash. So again, I could take it in cash. That's option one, but option two is a reduced paid up. So reduced paid up means I take the 50,000 instead of taking it in cash, I buy a term policy with a reduced face amount, but it's paid up for a certain amount of time that I wanted. So let's say I needed it for 10 more years or 18 more years until my children are grown or until my mortgage is paid off or whatever the purpose of that life insurance was. So instead of, say, take my 50,000 and I buy a term, but instead of 300,000, I'm getting maybe, let's say, 89,000 in coverage because that's all the 50,000 will buy. Okay. So reduced paid up means I got a new policy, but with a reduced face amount for a certain amount of time. So I'm paid up for a certain amount of time, but a reduced face amount. The third option is extended term. So again, you could probably guess what that means. You take the 50,000 and you extend a term out. You're buying a term policy for 300,000. So I have my same face amount, the same 300,000, but I'm just buying a term policy for as long as my 50,000 will buy me. So that 50,000 maybe buys me a term policy for 18 years and 7 months and 6 days. So I extend a term for 300,000 or the same face amount as I had before for as long as that 50,000 will, buy me, as long as it will last. So those are your surrender options when you have to cancel, give up, surrender the policy. Okay. Now, Russ will talk a lot about annuities, but basically I want you to understand one thing about annuity. It is not a life insurance plan. It is a retirement plan. So when you see the term retirement plan, do not think any of those terms or whole lives or permanent policies. It is an annuity. Okay. And Russ will go in a lot more depth on annuities, but just understand that annuities are for retirement. So like life insurance is addressing the risk of outliving your income, or sorry, life insurance is addressing the risk of the loss of, the breadwinner, the person dies and now replacing the income. Annuity is now addressing the risk of you outliving your income. So you're buying a policy that will pay you during retirement. So it addresses the risk of outliving your income. So if you see that addressing the risk of outliving income or anything about retirement, think annuity. Okay. So that will for sure be on your test. All right. Now, people are always scared of math questions on this test. There really won't be any math questions, but you may see an annuity question that seems like math. And it may say something like, you bought a $200,000 after-tax annuity. Okay, after-tax annuity. Today, that annuity is worth $400,000. And you're going to start withdrawing for retirement. How much of that is subject to taxes? This is not this is not a math question. It's just you put in 200,000 after tax, meaning you already pay taxes on this. Now it's 400,000 and annuities can grow tax deferred, so you didn't pay tax on the rest of it. So how much is subject to taxation? 200,000. The difference. Okay. Pretty simple. It's not really math. If you just read the question, read everything very carefully. After tax money was 200,000, that means you already pay taxes. So of the 200,000, of the 400,000, 200,000 you already paid taxes on, 200,000 is still left to taxation. Okay. So again, don't be scared of math. That's really all it is. Okay. Now, you know that the payor is the person who pays for the policy. The insured is the person whose life it's based on. Okay. And then you have the owner. So let me just go through this because I want you to be clear on these things. We could have a life insurance policy. So let's say I buy a policy on my daughter. Okay. And then my husband is the one it's coming out of his checking account. So I'm the owner, I'm the decision maker, I own the cash value, that's me. But it's based on my daughter's life. If my daughter dies, the death benefit pays out to the beneficiary. That's another person, the beneficiary. Okay. That's who gets the money. Okay. So I'm the owner. I'm the one who's the decision maker. I'm the one who bought the policy. My daughter is the insured because it's based on her life. And if she dies, it pays out. The payor is whoever's making the payments right now. So let's say my husband is hooked to his checking account. So my husband is the payor. And now, if my daughter dies, who is the beneficiary? So let's say I am the beneficiary on that too. So I would get the money. Okay. So you understand these concepts: owner, insured, payor, beneficiary. Okay. Now I'm just going to go through one more concept and then I'm going to turn it over to Russ. Okay. The beneficiary. Okay. The beneficiary. Again, let's say I have a policy on my life. I'm the owner of my policy. I'm the insured. It's based on my life. But my husband is the beneficiary. Okay. And if I die, he gets, let's say, the 300 grand. Okay. So he's the beneficiary, my husband. That's called the primary beneficiary. Primary. But you also can have contingents. Okay. So let's say I die, my husband gets 300 grand. But what if we died together? And so we can't pay him. So we have who's next in line to get that. And I can have a bunch of contingents. I have 4 kids, so I can split it 25% amongst each kid. Maybe you have a favorite kid and they get more. I don't know. But it's contingents gets nothing unless the primary is dead as well as the insured. Okay. So now there's also what if one of my kids dies with us? We're in a plane accident. Let's knock on some wood. But let's say we're in a plane accident and husband primary dies and one of the contingents dies. So how do we split up this guy's money amongst these guys? Okay. There's 2 ways. And I want to show you this. There's 2 ways. There's one called per stirpes and there's one called per capita. 2 different ways that we can name these beneficiaries. Okay, so let's say per capita, think of cap, think of head, think of decapitate. Decapitate is to lose your head, right? Your head's cut off. So cap has to do with head. Okay, so if this guy dies, per capita means that his percentage is equally distributed per head amongst the other beneficiaries. Okay. So his would be equally distributed between the other guys. Now, so that makes sense, right? Per capita, per head amongst the other beneficiaries, the money's distributed. Per stirpes means that this kid's money doesn't go to his siblings. It doesn't go to these other contingents. His 25% gets passed on to his children or his estate. It goes to his, estate, basically, his children. Let's say my grandchildren. Okay. So it gets passed on to the next in line and his estate or his children. Okay. So now a way I was taught to remember this, and it sounds silly, but if you think of per stirpes, think of herpes, it gets passed on. Okay. Sounds gross, but I bet you'll remember it. So per stirpes, it gets passed on like herpes. It gets passed on to his estate or his heirs. All right. So those are just some ways to remember all these different things. So I'm going to turn it back over to Russ now, and he's going to go through all these things. Take great notes, but more importantly, after you're done with this class, just start hammering and doing cramming on those three simulators.
All right, guys, so we're going to go through this material. Now, one thing I want to make sure you understand is if you have no prior experience or history with this industry or with these concepts, some of these things you're going to be hearing for the first time. Give yourself some grace. It's okay. Take some time to learn it. You know what I mean? Not years and years, but take a little bit of time to make sure that you are fully able to understand it, because the whole idea behind this whole process that you're doing is so that you can go pass this exam, so that you can go use this information, these licenses, to go help a bunch of people. So let's get into this here. So these are the concepts, the basic concepts that we're going to cover. These are all the things, and I want to make sure you understand one thing. Everything we're going to cover is what's going to be on the exam. So everything we're going to be going over or talking about is going to be a concept, a question, something that is going to be covered on the exam. Some concepts in more great detail than others, but you'll kind of get the idea as we go through this. And the reason for that we spend more time on certain things than others is because it will be more heavily weighted on the test itself. All right, so let's start with some basic concepts. The definition of the word risk. Risk is very simply defined as the uncertainty or chance of loss. There are a couple of different kinds of risk. Pure risk is, for example, the only possibility is loss. Typically with insurance, the only type of risk that insurance companies are looking for is pure risk. Speculative risk is where you could lose or it could also gain. So, for example, a lottery ticket, a poker game, things like that. Typically, you're not going to be able to insure those things through traditional insurance channels. But risk, very simply, uncertainty or possibility or chance of loss. Peril is the thing that actually causes the loss. So, for instance, in this case, death of the insured is what caused the loss. In accident and health, it could be an illness or an injury. So risk, peril, by the way, these things that are highlighted in bolded on the left-hand side of the screen, these are actually likely to be direct questions that are going to be on the exam. And then a contract of indemnity, very simply, the word indemnify is to make whole again. It's to put something back in the position it was in before the loss occurred. Transfer of risk, when you're buying insurance, what you're doing is transferring risk. You're not eliminating the risk. In other words, buying car insurance doesn't mean I'm not going to get into a car accident. Buying life insurance doesn't mean I'm not going to die. It means that I am sharing that financial risk with another, in this case, an organization, a company, that kind of thing. All right, so there are different methods to avoid risk to manage risk. One is to avoid it altogether. You want to avoid a car accident, don't ever get in a car, as an example. Retaining the risk. In other words, I am owning that risk is going to occur. For instance, with certain types of insurance, you have deductibles that are factors in what you're, that you have to pay before the benefit kicks in. Reducing the risk. If I want to reduce my risk of heart disease, cancer, that kind of thing, changing lifestyle will reduce the risk of an illness or an injury, or it doesn't reduce the risk of death. We're all going to pass away at some point, but it reduces the likelihood that it'll happen due to a heart attack, stroke, cancer, that kind of thing. And then sharing the risk. This is, where you have, in health insurance a lot, you hear about co-payments or co-insurance, where it's an 80-20 or a 70-30 plan. And what that means is that you're taking on 20% of the risk. So whatever happens, you're responsible for 20%, and that insurance company is taking on 80%. Law of large numbers is a subject that will be covered to some degree. And basically what that is that's what's used to calculate insurance premiums. So it isn't based on an individual human. It's based on the likelihood of death or illness or injury to that entire group. So, 42-year-old men in, actually location is not relevant, but 42-year-old men with certain health conditions, this is what the premium is going to be based on. Versus 35-year-old women with this health condition, this will be based on. Versus 26-year-old men with no health conditions. You get the idea. It's based on the averages of a large group of a particular type. The concept of adverse selection covers basically when a company takes on bad risks or poorer risks, which tends to drive up premiums for basically everybody. And in many cases that, not many cases, but in some cases, those will be the folks that are seeking the insurance coverage. But the companies tend to want to stay away from those risks because it makes them less viable, and it also puts them in a position where everybody's rates have to go up. So the concept of adverse selection is something that will likely be covered on your test. All right, different types of insurers. You have an admitted insurer, an authorized, or a non-admitted, non-authorized. Again, a lot of these concepts, and I'll just be very blunt and frank with you, you're not going to have a lot of use for these beyond the day that you pass your exam, but you will need to understand them to a degree to pass your exam. So this is an example of that, this page. The three different types of insurers: you've got domestic, you've got foreign, and you've got alien. Domestic means in the state where it's authorized. So if you're in Massachusetts, Mass Mutual as an example is what it gives, would be considered a domestic insurer. A foreign insurer would be within the same, it's authorized to conduct business in the state, but it's not its home state. So if Mass Mutual can do business in Utah, for example, they would be considered a foreign insurer in the state of Utah. And then alien is they're outside of the country altogether, but they have they're able to conduct business in the States, but they're domiciled, or they're headquartered in another company. So this gives the example of Sun Life of Canada. All right, I'm not going to get into this too much. Just take a picture of this slide for your purposes. This gives you an idea. This type of information will be covered on the test. We don't need to get into this because the slide itself is pretty self-explanatory. All right, so the concept of agency, the relationship that exists between two parties when one party acts on behalf of another. There are different types. It's basically the authority to act on behalf of. So in this case, you've got actual agency or expressed, where I put in writing, I authorize, ABC agent or ABC company to advertise, or to act rather on my behalf. Then you've got implied. This is, it may not be written down, but it's sort of understood. So the agent signing the application and collecting the premium, as an example, would be acting on implied agency. So it doesn't say specifically, Russ Kobrin has the authority to do that on that application, but based on the fact that I am appointed, I'm licensed, there's an implied agency there. And then apparent is basically that it may not be actually official in any way, shape, or form, but there's a perception that that is the case. And when the contract is in effect, in other words, when I'm approved to work with an insurance company, the insurer, basically I have to do the best I can to represent both client and insurer, for the reason that the insurer, the company, is bound by whatever I do. So let's say I take a check for a policy as an example, and I forward that to the insurance company. But there's something about that risk that isn't good. That's something that would cause the company to have an adverse selection in that process. The insurance company is still bound to underwrite that policy. They don't have to approve it. But if I say X, Y, Z, I'm acting on behalf of the company. So there's an implied agency and an implied they're required to act based on what I said. All right, some other aspects. These are the four different aspects, four different characteristics or elements of an insurance contract. The first one is an agreement. There's an offer made, and that offer is accepted. Consideration. Now, in plain English, what this means is I'm giving you something in exchange for something else. Don't overcomplicate it. Consideration means something for something. Just keep it very simple like that. Legal capacity. Both parties must be legally competent to enter into a contract. So as an example, you could not enter into an insurance contract with someone who has dementia, just as one example. This gives, some of the examples of people that would not be considered of legal capacity. And then legal purpose. So there has to be a logical legal reason for that contract to exist. And you see here it says it cannot be contradictory to the good of the public. All right. Again, just some terms that will be included in the test itself. Conditional. So basically what conditional means is that the insurance company's promise is based on certain things existing. So for example, if I submit a policy and it is known at the time that that person has cancer, as an example, the insurance company is not bound to protect them under any circumstances. But if they're healthy, and let's say they get into a car accident during that time, assuming everything we've said in the application is true, then they are required to act, based on that conditional receipt, based on that, on the conditions that are set forth. Life insurance contracts are personal since they benefit individuals, so they're considered personal. Again, these are key words that might be on the test. Utmost good faith means that we are both insurance company and agent and potential insured or policy owner are acting based on with the highest integrity and honesty. Um, Fiduciary is someone who's basically saying, I'm going to take financial responsibility. I'm going to do what is in the best interests of this individual or of this family or of this business. And it is a position of trust. Unilateral means it's one-sided. So the insurance company basically has control as long as the premiums have been paid and as long as everything is accurate in the application as issued, the insurance company, it's a one-sided contract. So basically the payment of premium has already occurred. So the promise is I'm going to pay you, or I'm going to pay that death claim or that living benefit claim or whatever it is in exchange or in consideration for the fact that you've already paid me that premium. All right, contract of adhesion. Another way to look at this, and this is kind of how I like to simplify things, is it's we don't have a choice but to follow along with the rules of the contract. It sort of is a take it or leave it situation. And there are basically anything that is unclear about the contract will favor the insured, not the insurance company. So for instance, if it says, and this is, I'm just giving you this as a hypothetical example. Don't take this as gospel. If it says it may be paid under circumstances X, Y, Z, and it's not real clear what the may refers to there, then that would technically transform to a would versus a may. So making sure that if it's any sort of gray area whatsoever, it's going to favor the insured. And aleatory means that one party may receive a value that's greater than what was paid based on a possible future happening. So uncertain outcome, the death benefit, that kind of thing. Absolutely. All right. So some further terms. A warranty is a statement made by the insurer or its representative that's guaranteed to be true. Statements on the life and health application are considered representations, which you see listed just down there below. So based on the best of my knowledge and belief, is everything I'm saying here true? It's based on the best of my knowledge and belief. I am not going through a person's pharmacy records, as an example, or their medical records. I'm saying based on the conversation that I have had with that client, with that family, based on everything I see and I'm aware of, this is what I'm stating is the case. It has to be made prior to policy issuance. It can be changed prior to the policy being issued, but not afterwards. I'll give you an example. I had a client, this is, 10 years ago. We filled out an application, went through all the underwriting questionnaire, the medical questions, and initially presented himself as a non-tobacco user. About a week later, he calls me and said, listen, what I told you was not 100% accurate. I don't smoke a lot, but I will have, 2 to 3 cigarettes a month. Policy was still in underwriting. I called back the insurance company. I reported that the rate was changed appropriately. And when the policy was issued, it was issued based on full facts. So a representation may be changed. Now, had that client called me after the policy had been issued, it would have been a different conversation, which we'll get to shortly. But just so you kind of get the idea, as long as it is done before the policy is issued, you'll be okay. Well, it won't be considered a misrepresentation or material misrepresentation. But if you try to do it after the policy's been issued, that's a different conversation. So misrepresentation is a false statement that won't affect underwriting. And it's not considered material. It won't affect whether it's not going to change necessarily the outcome or the rate class or anything like that, versus a material misrepresentation, which is something that directly will affect the issue of the policy. So, the client somehow manages to hide the fact that they had cancer. It was 10 years ago, but they managed to not disclose the fact that that's the case. Or, they say they weigh 210 pounds and it turns out they're over 300 pounds. As an example, these are the kind of things that could have an effect on rate class, on underwriting, on how these sorts of things are received. So material is something that is very critical to make sure we're not doing. If it's a misrepresentation, something like, I don't know, they got my zip code wrong or something along those, or I screwed up on my zip code, or I said I've been working at my job for 5 years and it's really only 4 years, as an example, things like that. Obviously, we want our clients to be honest in all of their dealings and everything that, that they're telling us. We want it all to be the truth. But just make sure that on the critically important things that we're talking about here, that we are obviously being honest as agents, 100%. We are, again, that's that previous statement, to the best of our knowledge and belief. And the client is also stating to the best of their knowledge and belief. So keep in mind, it's not just on us, it's on them as well. So if the client, all the client can be expected to communicate is what they know and what they should know. We can't, maybe whatever the situation is, if they have something undiagnosed that they're not aware of, that's a different conversation. But if it's something that they're aware or should be aware of, then yes, that has to be disclosed. All right, concealment is failure to voluntarily disclose material facts relevant to the underwriting process, whether you mean to or not. Fraud is I'm doing it on purpose. So concealment doesn't matter intent. Fraud is, yep, I really did my best to make sure that you, Mr. and Mrs. Insurance Company, do not know that I am a pack-a-day smoker. Whatever I had to do to make sure that you didn't know that, I did that. That is considered fraudulent. And in the event of fraud, the contract may be canceled or rescinded. All right. This is just some information regarding what they're going to be looking at, what the underwriters are looking at. We don't need to go through this in great detail. By the way, a lot of this stuff is also going to be covered. In fact, the vast majority of it is covered on your pre-licensing class. So just know that. There's also, as Jamie mentioned, those final exams that you have to work with, or that you have to work with. You don't have to work with them. 85s, 90s, you're going to crush it on this test. But just kind of go through some of this material. These are some of the factors that affect the premium. You can get an idea here. Obviously age, gender, occupation. If someone is a computer programmer, they're less likely to pay a higher rate than someone who is a stuntman or a stunt person, as an example. Personal health history, habits. Do they smoke? Do they drink? Now, drinking occasionally, not necessarily an issue. Drinking a lot could have an effect on the person's rating. What are their hobbies? If they're a competitive motorcycle racer, these kinds of things can have a different can make a difference. How much do they make? Very important to make sure that that they're being adequately insured, but that they qualify financially for that. And that's insurance company specific. But these are just some of the factors that these insurance companies are going to be looking at. All right, so time frames that are important. There's what's called a 10-day free look period. That means that within the first 10 days of taking that policy, I have the right to return to the company, say, no, I don't want it, for a full refund of the premiums I paid. For seniors, and each state defines senior a little bit differently, which is why it's not specifically stated here, but that free look period is typically going to be 30 days. And sometimes you will have the first premium paid with the application, sometimes not. We're going to go through a couple scenarios here on how that first premium affects it when the contract protection begins, but note that it's not mandatory in all cases for that to be collected. So sometimes it will be, sometimes it won't be. All right, so this gives you an example. On January 10th, the application was submitted with the premium. It arrived on January 13th, excuse me. The physical exam was completed on the 16th. The client was denied, or the proposed insured was denied on March 1st. They were never covered because coverage is only provided if the policy is approved as applied for. By the way, the applicant died on January 20th, so there was no coverage in place. Applicant provides the information and the premium, the insurability type, conditional receipt. The home office begins underwriting. Policy is issued. Coverage is immediate if the policy is approved as applied for. January 13th, home office receives the paperwork. Home office approves it. And the client accidentally died on January 17th. Was that covered? The answer is yes, because the policy was issued as it was applied for. So there's no issue there. The conditional coverage kicked in at that point. They provide the application information and the premium. The conditional receipt is given. They have to take a physical exam. On January 14th, they complete the physical exam. On March 11th, the contract is issued, again as applied for. The coverage became effective when? This date here, when the applicant completed the physical exam. If it's required, that's when coverage kicks in. So that's the date that it started. The applicant died on January 17th, so it was covered because it was after the date of that physical exam. And if it's submitted without premium, pretty simple here. On March 12th, statement of good health, which means that they've had no health issues since the application was submitted. Premium is collected. The policy is delivered. The applicant had actually died on March 9th. Were they covered? The answer is no, because it was prior to premium being collected. So there's no coverage in place until that premium is collected. All right, so now we're going to go into a couple different types of term insurance or different types of insurance. Jamie's already kind of gone over with you some stuff about whole life and some other things. So this is just, some of this is going to be a bit of a review, but I want to make sure that you all kind of have an idea of the different types of policies. Another word that you'll see on the exam for term insurance is pure insurance. So if you see that pure protection, if you see that on the exam, it says pure insurance, what it's referring to is term. Only death benefit, there's no cash value. It only pays if the death benefit if the death occurs during that time period. So it's going to be somewhere between, it could be annually renewable, so annual, 5, 10, 15, 20, 25, 30. The longest I've seen is about 35 years. So if the death occurs within that time period, the full death benefit is typically going to be paid. The advantage is it costs less. It ensures that you are insurable. It could be used for debt or mortgages. And the disadvantage is if the policy is a 30-year policy and the person passes away at 30 years and 1 day, there's no coverage provided. It can be renewed at the end of the renewal period. That's the upside. The downside is typically it's more expensive. And it can also be converted. A term policy in many cases can be converted to a whole life or a universal life policy, and it's typically going to be without a medical exam. This gives you an idea of the different types of term insurance. So you've got a death benefit that's level. In this case, let's say it was a 10-year period. So 10 years, term begins, term ends, the premium is here. It gets renewed over here. The death benefit is still the same, and it's still guaranteed for X period of time, but the premium, if you notice here, is higher. And then last but not least is the person wants to renew it for a third time, and the premium is even significantly higher. So the premium is probably doubled or tripled, if not more so. And in fact, in most cases, it's significantly more than that from the first time the policy was written to the last time it's renewed. So the new contract begins with the same death benefit, but the premium is going to be significantly higher. A decreasing term policy, it starts at $200,000, it declines to zero. Typically, it is used for a loan or a mortgage of some sort. So someone will do a 30-year decreasing term policy that basically just ensures that if something happens to them, their mortgage gets paid off. All right, now there are different types of permanent policy. This one is whole life. And basically at age 100, what's going to occur is it's going to endow or mature. So what that means, all that means when you see that word is the cash value equals the face value at that point. So if you have $100,000 in your cash value and it's a $100,000 policy, that policy has now endowed, and a whole life that occurs at age 100. It'll begin to build cash value after a couple of years. If you accelerate the premiums, you'll see that sooner. Increases with every premium payment. Single pay is the most expensive initially, and the reason for that is because you're paying the most upfront, but over the time of the policy, you're paying the least amount. And this gives you an idea of how often you can pay the premiums. You can either pay them once, set number of years, to a particular age, and then it'll be calculated based on how you want to pay those premiums. All right, we're going to skip that. All right, so adjustable life. Basically, it's a permanent policy with all the characteristics of whole life, except the premium and the face value may both be adjusted up or down. With a whole life policy, once those things are set, they're fixed. And if you want to increase the death benefit in a permanent adjustable life policy, you're almost always going to have to get more underwriting. And I say almost, I actually believe it is always. It can also the type of coverage. It can alter the premium payment period. It can alter the premium payment. You can put in more than what's needed, and if there's a goal to build some cash value in those policies, then that would be when you would want to do that in many cases. And then it could also change the protection time frame. So maybe the person wants to make sure that they have coverage in place until age 95 or age 100. So you can adjust these things to make sure that it's meeting exactly the client's needs. It's going to be flexible. Typically, there's going to be a cash value of some sort. There will be a guaranteed minimum interest rate. A lot of these contracts, the guaranteed minimum interest rate they offer is zero. So what they're guaranteeing is that you won't lose money. In some cases, they're 0.75, 1%. But the worst case scenario is you're guaranteed principal protection. The insurance company investments maybe allow for an increase to that guaranteed interest rates, but contractually there'll be a contractual what they're required to do. And in many cases, partial cash value withdrawals are going to be allowed. There are a couple different death benefit options. You've got option A, which is level death benefit, which means that the insurance, the death benefit payout of the policy includes the cash value. Option B is the level death benefit. So let's say it's a $200,000 policy and there's $100,000 in the cash value. That now gives you a $300,000 death benefit. So with the first one, a $200,000 policy and $100,000 in the cash value, you'd get a $200,000 death benefit. With that second one, which is called option B or increasing, it's going to be the death benefit plus the cash value of the policy. Death benefit is not guaranteed in the UL contract, and this applies to all types of UL because the owner can change the payment at any time. So let's say the person's putting in $500 a month for the first couple of years, and they decide they want to go down to $200 a month, but the insurance company has guaranteed that death benefit based on $500 a month. It would throw the whole thing off. So that's why the death benefit is not guaranteed. All right, so variable life. All the characteristics I just described, with the one difference that the money is invested in what's called a separate account, and there is no guarantee. So if the investment choice goes up, great, you make money. If the investment choice goes down, you don't lose money, you lose money as well. Now, we're not going to spend a lot of time on this because with just a life license, you need to actually also get a securities license, either a federal Series 6 or a Series 7 to be able to write a variable universal life. So don't focus too much attention on this, other than the fact that it is going to be on the test. You're going to need to know it. All right, so consideration clause. So basically, application information and premium in exchange for the insurer's promise to pay. So the insured and the owner and the agent are giving all this stuff to the insurance company with the understanding and agreement that should everything prove to be true, there's enough premium, the insurance company is promising to pay. So the owner's right, the owner is promising to pay the premium. The insuring clause is basically what lays out the details of the policy. It provides the death benefit, how it's being paid, who are the beneficiaries, what are the exclusions. And here I was mentioning this earlier, the incontestable clause. So basically, if the insured files a claim, or if there's a claim filed within the first 2 years of issue of the policy, the insurance company can contest that. Now, they're not just going to do so for the sake of doing so. But let's just say, for argument's sake, that you have an insured that a month after the policy is issued, they pass away from cancer. Well, the insurance company is going to want to know that this person didn't somehow know they had cancer prior to the policy being issued and somehow get it through anyway. So they're going to take a look at that after by the way, within that 2 years, if they deem that it was fraudulent and that it shouldn't have been issued in the first place, what they will do is rescind the policy, so effectively act as though the policy was never issued, and they refund the premiums to the policy owner. This is really put there to protect the insurer. Now, after 2 years, the incontestable clause goes away. These are just some of the exclusions, reasons why a policy would not, why a death benefit would not be paid. Criminal acts, we don't need to get into specifics on that. But if you're in the process of committing a crime and something happens to you, they're probably not going to pay. Suicide in the first 2 years, acts of war, that kind of thing. Again, these are the types of questions that will be covered on the exam as well. Free look position, we covered that, so we're not going to go through that again. Now, this is something that may come up. If there's a misstatement of age or gender, it's typically not going to void the policy. But if I misstate my age, if, oops, the person put a 7 at the end of my birth year and it's actually a 6. If I make myself older than I am, then the benefit will be higher than what I signed up for. If I make myself younger than I am, I said I'm 65 and I'm actually 67. I'm neither one of those things, by the way. But let's just say I said I'm 65 and I'm actually 67, then they would adjust it to what it should have been at the issue age, and that's what I'll be paid. Now, as far as converting the policy, if you're going term to term, no insurability is required. Term to whole life, no insurability is required. Whole life to term, they're going to want to basically make sure that you are still insurable, as long as it's, of course, within the same company. Nationwide is not going to let you convert their term policy, or Transamerica is not going to let you convert Nationwide's term policy to them without verifying insurability. All right, some base features: waiver of premium. It's a rider typically in most cases. It prevents lapse if the policy owner becomes disabled and can't pay the premium. Reinstatement, basically if the policy lapses within 3 to 5 years, you have to have proof of insurability and back premiums. And after 45 days, if they haven't done anything with it, the coverage is automatically in. Now, if the policy was surrendered, you don't have the right to come back and reinstate it. This is only if it was canceled or lapsed due to non-payment of premiums. Grace period is typically, it protects the policy owner from unintentional lapse of the policy. So it covers you up to 31 days after the premium was due. Are you covered during the grace period? The answer is no, typically not. and the premium owed would be subtracted from the death benefit under those circumstances. Automatic premium loans, you get the idea what that's about. So you have to select at the time of the application. That basically means that you can use a premium loan to cover the the cost of the insurance if you need to, for the purposes of making sure the policy doesn't lapse. Premium mode refers to how it's paid. There's 4 different premium modes typically. Monthly is going to be the most expensive, and annual is going to be the least expensive. And basically, it's a way of allowing the insurance company to charge a bit more for the more payments they have to process in an annual period. They're allowed to charge a fee for that, basically. So this, on that right side, you see assignment. That's basically the ability to transfer ownership, transfer owner's rights to another policy. So it could be used. Someone could use an insurance policy as collateral for a loan, as an example. That's a collateral assignment. An absolute assignment is I'm giving up all rights to this policy whatsoever. So if, for instance, we have policies that we set up for our children, as those they finish school, finish doing what they're doing, they start their careers, they start their life, we have the ability to give them those policies, and then they can, of course, should keep funding them. But it gives them basically total ownership and total control over those policies. All right, this is just some different terms, different features of the contract. We're not going to spend a lot of time on this. We'll go on to the next slide, but you can go ahead and take a picture of this one if you want to. Give you a second to do that. All right, some riders that you will see included. You've got an accidental death benefit rider, and basically what that does is increase the death benefit under the circumstances that it occurs in an accident. Client has a car accident. It could be 2 times. It could be 3 times. There's additional cost for it typically, but the cost is very minimal in most cases. Guaranteed insurability basically allows the person to purchase additional life insurance at future dates, and they don't have to take an exam. So it's basically buying your future insurability at the time that you buy the policy in the first place. This gives you examples of some of the other types of riders that may be factors in the contract itself. There's typically going to be a cost associated with those contracts. None of them are mandatory, and as you're meeting with clients, you can go over what the needs are that they're truly looking to fill, and then determine what riders would be right for those particular clients.
I just think of a rider from the test, I don't know why, I thought of a little, like a turtle, mama turtle with a baby turtle riding on the back. So it's riding on the policy. It's something addition that's just kind of riding on the policy. And if you kind of understand that, you understand it's not the main insurance. It can be dropped off at any time.
Absolutely. All right, accelerated living benefits, accelerated benefit rider. These are newer. Well, the terminal illness rider is something that's been included. I've been here 15 years, as long as I have. But the living benefit riders are something that are newer. In most cases, people are assuming that they have to die to get the benefit from their life insurance policy, and that's no longer the case. There are riders that can be added that pay out if the person becomes ill or injured. And it's something that's serious, not, like cancer, heart attack, stroke, along those lines.
It accelerates when you're getting the face amount, the death benefit. It just gets it. Think of accelerated. You're getting it sooner than death. You're accelerating it.
Absolutely. So this one, I spent a little time on this because a lot of the policies, well, actually not a lot, just a few of the policies that we actually offer these as sort of built into the contract. So in some cases, they are riders that you have to add on, but in some cases, they're just included in the policies that we offer. Viatical settlement, don't spend a lot of time on this because we don't do it, but basically what that means is I'm selling my life insurance policy to someone else. They're paying me a sum of cash now that's going to be typically less than the amount of the insurance policy.
On the test.
It is on the test. Yeah, it is.
Stay away from viaticals.
Yeah, we don't do them.
It's
no good. All right, so here's some specific life insurance concepts. There's a lot of different business use of life insurance. And it's good to know those as you're out talking to folks so that you understand how you can help business owners. It isn't just individual families, although we do a lot for individuals, for families, but for business owners, key employee is very simply this. I own a business. I have an employee that is key to my operations. If they're not here, my business doesn't function. I own a bakery and the baker passes away, for as an example. I can take out a life insurance policy on that baker. I pay the premiums. Me personally, but my company is the beneficiary. And that if God forbid something happens to that baker, I can use that money, first of all, to keep the doors open while I'm finding someone to train, while I'm basically getting my business back on track.
Yeah, I would the example I use for key employee is, let's say I'm NBC and I have my late night talk show, Jimmy Kimmel or whoever the guy is, right, at the time, and I have, let's say, a 5-year contract and he brings in a certain amount of revenue. So I'm the employer and I might buy a 5-year term insurance policy because I don't need permanent insurance. I get a 5-year term insurance for the length of that contract. So if Jimmy Kimmel dies, I have a death benefit that can either replace him or replace the income he brought in. And buy sell is a little bit different. So buy sell is, let's say me and Russ are business partners. And he's like the marketing guy and I'm the person that's really the technical person and the internet guy or whatever. And so we have this great business, but we might buy a life insurance policy on each other's life. Okay? Because if he dies, I don't want to be in business possibly with his wife who doesn't know the marketing side. So it's a life insurance policy that we buy on each other and it pays the wife out. So now I'm a sole proprietor. Okay. So pretty simple to understand those ones.
All right, now in group life insurance, and the group plans are something that's going to be covered on your test. The employer receives a master contract. The employee receives a certificate of insurance. Don't overcomplicate it any more than that. That's pretty much all you're going to need to know on this subject. Other than the fact there are two types of plans. Non-contributory means 100% of the premium is paid by the employer. 100% of the employees are covered. In a contributory plan, the employer pays a portion and I pay a portion, but I have to have at least 75% participation in order for a contributory plan to exist. So non-contributory, I'm paying, and the way I look at that is I as an employee, well, I'm not an employee. The employees are non-contributors to that plan. I'm putting everything in as the owner. In a contributory plan, the employees are contributing and they have to do that. All right. We're going to talk a little bit about annuities. Now, annuities are not going to represent a large portion of the test. So we're not going to spend a huge amount of time on this subject, but just understand an annuity. Think of it like this. If you think of a life insurance policy as you're putting in small sums of money to create a large lump sum, think of an annuity as the exact mirror image of that. You're giving an insurance company a large lump sum of money. In exchange for that, they're going to give you income, either for a specified period of time or for, in many cases, in most cases, for as long as you live. You want to say something?
Well, I was just going to say, like I said earlier, that the annuity addresses the risk of outliving your income. So on your test, if you see anything about retirement, they are not talking about life insurance. They are talking about annuity. This was a really confusing concept for me for a long time. But, you just want to know, again, there's the variable, that's the stock market, that's not, right? But there won't be a ton on there about this.
It represents, I don't know the percentage, but a very small percentage of your exam. So you're going to learn so much from your trainers and your senior marketing directors on this subject. Remember, guys, the whole purpose of this process is so that you can pass the exam. And I hate to put it this way, actually, I really don't. That's really where the true learning begins in our business, is when you're out in the field, you're out sitting down with folks. So everything Jamie and I are covering with you today is really to get you to the point where you can get that piece of paper that says pass on it. So just know that. Yeah. Different types of annuities. We'll spend a minute on this. Qualified annuities are money that has not yet been taxed. And another term I use for this, well, not just me, but in the world, is retirement money. If it is money that is going in and it's a qualified annuity, that means I have not yet paid taxes on this money, which means it will be taxed when I take it out from $1. Not just what I put in, not just the gains, but everything I put into it as well. A non-qualified annuity is the exact opposite. The money that I put in has already been taxed. So I'm only going to pay taxes on those gains, and those I will pay taxes on when I withdraw them. So just know that. All right, when premiums are paid, so there's different ways you can do it. You can put in just premium one time, where let's say, and I'm working with a client right now. She's about to put about $495,000 into an annuity. She doesn't plan to put any more money into that. She's rolling that over from a different account. Her plan is to use that for income at some point down the road, but there's not going to be any further contributions to that. Versus in some cases, you can put it in where you put in a lump sum up front, 10, 25, as little as 10 or 25,000. Most people are putting in more. And then you can contribute $500 a month or $1,000 a month if you want to.
I think the one thing to remember is when you're putting money in, this could be like you're lump summing a bunch of money and it just sits until you're ready to take it out at retirement, or you're putting in monthly payments or annual payments. That's the periodic premium, right? but that's called the accumulation phase. When you're putting money in to an annuity, it's called accumulation phase. When you're taking money out, it could be the annuitization phase. That's when your retirement income or distribution, but annuitization means that you've now annuitized that thing and they are now giving you a certain amount of money every month. You don't outlive your income. Okay.
Now, from that standpoint, there's two main categories. Immediate. I'm putting the money in, I have to start taking it out within 30 days. And it's going to basically guarantee me an income stream for either a specified period of time or for as long as I live. The vast majority of the annuities that I have personally written have been deferred, where I'm not going to take the money out right now. It's going to be a year, 2 years, 5 years, 10 years down the road when I'm going to start taking that money out. And you definitely have some overall better features and benefits. Now, it's obviously going to be based on what's right for the client.
Deferred to a later time.
Yeah, put off to a later time.
Cool.
All right, these are just different options for the annuity. Look, snap a picture of this slide, and you can refer back to this later.
Well, remember, there's fixed, which is guaranteed, variable, which is hooked to some type of securities investment, stock market type thing. And then you could have an individual annuity, or then you could have one joint life, and that's based on not just you, but maybe your spouse as well. Okay.
And then equity indexed, which is kind of the best of both worlds. Again, has to be right for the client, but that's where you've got upside potential and you've got no risk.
Yes, love those. Okay.
All right. So when it comes to taxes and life insurance, there's this concept that you'll hear people say MEC, or modified endowment contract. In plain English, what that means is that there is a guideline on how much you can put into that specific policy, which is based on the death benefit, and you put too much money in. If something becomes a modified endowment contract, that means that too much has gone into it. Basically, there's what's called a 7-pay test. There's an X amount of premium that's allowed during the first 7 years of the policy, and if you put more than that in, it becomes a MEC. Under those circumstances, the gains are taxed basically they're taxed as ordinary income, and you have to pay penalties on those as well. On group life insurance, the death benefit is tax-free. The premiums are deductible by the employer. And the first $50,000 of group life is also tax exempt to the beneficiary, or sorry, to the employee as well. All right. So this concept of a 1035 exchange, I'm going to keep this very simple. It is basically trading a life insurance policy for another life insurance policy, or an annuity for another annuity. And there's an IRS code that allows this to occur. And the reason the IRS code exists is to make this exchange tax-free. So if someone has a whole life, they want to change it to a universal life, and they take the cash value from that whole life and they put it in that universal life, that becomes a tax-free exchange. Someone has an annuity, they want to transfer to another annuity, that becomes a tax-free exchange. You'll hear the term a 1035, or I 1035'd it. That's what that's referring to. You cannot exchange an annuity for a life insurance policy. You are creating a taxable event if you do that. All right, so if you hear that term, 1035 exchange, what that means is I've exchanged a life insurance policy for a life insurance policy, or an annuity for an annuity. And the basic premise, and we won't get into more detail on it than this at this point, is the exchange has to be in the best interests of the client. Either a better company could be one of the reasons. You're exchanging it from to a company with a better rating, better returns on the new product, improved benefits on the new product. But in some way, it has to be improving the client's situation overall to move that money, or to change that product. All right, now we're going to go over some concepts that are specific to accident and health here. So this thing called ERISA, or the Employee Retirement Income Security Act of 1974, that's a lot of words. Basically, what it was designed to do was create rules for retirement plans to help protect employees. So there are some rules. For instance, you got to be, if you have a plan, it has to be offered to anyone that's 21 and over, and works full-time, at least 1,000 hours per year. Beyond that, you have some discretion as to who you offer it to, but it has to be offered to everyone in that category. In a traditional retirement plan, as you can see on the right side, these benefits are taxable. 10% penalty if you withdraw prior to age 59 and a half, except for the reasons listed there. And the employer and employee contributions are going to be tax deductible. The earnings are going to be tax deferred. So you're not going to pay taxes on those gains until you take that money out. And take a picture of this for your purposes here. This gives you just some basic information, kind of like a bit of a flow chart on the different aspects of it, whether it's a traditional or a Roth. Now, one thing to note here, it talks about rollovers. In a rollover situation, the owner receives the money and then forwards it to a provider. You can only do one of those a year, and it has to be completed within 60 days of receiving the funds. If the owner never receives it, it's called a trustee to trustee transfer, and there's no limit to how many of those that you can do per year. All right, so within the retirement plan world, in order to benefit, to qualify for Social Security, to get maximum benefits, you have to have worked for 10 years. You have to contributed for 10 years. And you have to be currently insured. So in other words, out of the last 13 quarters, so out of the last, 3 years plus 1 quarter, you have to have 6 quarters of coverage during that time period. This is how it's funded. And this gives you the idea of some of the benefits that you can receive. All right. So there's different types of health insurance providers. You've got commercial companies. Those are just traditional insurance companies. You've got group plans, which are offered through employers or trade associations. And then you've got government plans. This could also be called TRICARE. And these are government organization that provides health benefits for dependents of military. This gives you a bit of a difference. Again, just go and take a picture of this difference between an HMO and a PPO. If you think of it as an HMO where you have a gatekeeper, and every time you want to go see a specialist, you have to go through that gatekeeper, versus a PPO or a preferred provider organization where you don't have to do that. If you want to go see a dermatologist, you just find one that's covered and you can go see that dermatologist. All right. The different types, there's a traditional fee-for-service. You've got disability income, which is a health insurance plan. You've got a medical expense plan, and then you've got a long-term care plan. Medical expense insurance is what is most commonly referred to as I have health insurance. That's typically what they're talking about. Disability would cover these things. Basically, you cannot perform your own normal occupation is the standard definition of disability. More restrictive, which would be more expensive, is I can't perform any occupation based on what I do. So for instance, let's say I was a dentist and I can no longer perform as a dentist, but I can teach. I can go be a professor of dentistry or whatever that would be called. And then any occupations, I can't do anything. There's no occupation that I'm able to do. And in order to qualify for this benefit, typically you have to be under the care of a physician. Now to clarify, I'm not saying to qualify for the policy. I'm saying to qualify for the benefit. All right, so with health insurance, the premiums are based on the elimination period. Sorry, with disability, forgive me, based on the elimination period. And elimination period is basically just how long until benefits are paid. The age, the sex, the health, the occupation, and income. What's the monthly benefit you want? If you want $3,000 a month, it's going to cost you less than if you want $6,000 a month. How long do you want the benefit to be? If you want it for 9 months, that's going to be less than if you want it for 2 years or indefinitely. And also they're going to look at what other disability income policies that you have in force, or disability insurance rather. All right, so with health insurance, with medical expense, this is, again, what you know traditionally as health insurance. And there's 3 basic. You got a basic plan, first dollar coverage, no deductible. You've got major medical, where basically you're going to have a deductible. There's going to be more benefits. And then you've got dental insurance. So with a basic plan, this will cover daily room and board, for instance, $250 per day for 100 days in a hospital or that kind of facility. Then you've got the miscellaneous expenses. This would be used for other things, the x-rays, dressing, every time they give you that $35 aspirin when you're in the hospital, ambulance rides, anesthesia, and then any other additional expenses, not any, but some other additional expenses that might be paid by the insured. And then surgical expense covers the cost of, typically the doctor, the surgery itself, maybe the nurses that assist, the operating room, that kind of thing. Did you want to say something? Okay. All right. These are some exclusions for health insurance. Pretty self-explanatory thing. If you want to get a tummy tuck because you feel like it, they're typically not going to cover that. Routine dental, your cleanings, that sort of thing. And long-term care private nursing is not going to be covered under your normal health insurance policy. Of course, self-inflicted injuries. There's going to be higher coverage limits. In some cases, it can be unlimited. There's also going to be a deductible where you have to pay that first. and then the insurance company pays their benefit. In some cases, it's co-insurance where you're paying 20%, they're paying 80%. It just really depends on the type of medical expense plan that you have. Go ahead and take a picture of this. So this says the claim is $80,000. The policy has a $500 deductible and an 80/20 copay. So the deductible is $500. 20% of that bill is $5,000. Since the insured has met the stop loss, they're going to pay $5,000. That's the most they have to pay with that stop loss. And a stop loss basically means the high limit. So that stop loss, I look at that as the wall. At that point, I no longer have to pay any more expenses out of pocket. Without that stop loss, they would have paid 20% of $80,000 plus the $500 deductible, or $16,500. So you'll see on your health insurance explanation of benefits, it doesn't say stop loss, it'll say out of pocket maximum, which is different from a deductible. Make sure you know that because that's important for the test as well. In dental insurance, there's different categories of treatments. Make sure that, for your own use, you're looking at your explanation of benefits, what does it cover, your outline of coverage to determine that it covers the things you want it covered, you want it to cover. Group plans, you can typically get dental through group plans or individual plans. It's fairly, inexpensive, generally speaking. But you get the idea. The typical point of dental insurance, or the main draw of it, is it's going to assist you with keeping your teeth healthy. But once you have needs for things, there's going to be some more significant costs associated with it. But like your cleanings, your checkups, that kind of thing are typically going to be covered under your dental insurance. All right, long-term care is not just for seniors, despite what you may have heard, you may have had people tell you. It could be younger people. It's really just someone that is unable to perform two of the activities of daily living for at least 90 days, or they have some sort of cognitive impairment, Alzheimer's, stroke, some other dementia. So anyone of any age that has those one of those two things occur now, is going to basically qualify for a long-term care benefit. Now, if you've already got one of those things, you're probably not likely to qualify for a long-term care policy, but you can qualify for the benefit assuming the policy was already in place. And Medicare does not provide a lot for this. Typically, private health insurance does not provide a lot for this. A lot of the life insurance policies that we offer it as a rider. Transamerica has one, Nationwide has one. Different companies that we offer have this long-term care as an additional rider that can be included. You can also buy it as its own individual standalone policy. This gives you an example. The longer the period you want covered and the higher the benefit, the more expensive the premium is going to be. So this gives an example of $300 a day for 3 years would be $328,000 of a maximum benefit. That's going to be more expensive than if you want $200 a day for 2 years. So you get the idea. These are the things that are required to be covered. You have to have assisted living care, respite care, which basically, let's say you have someone that's taking care of you full time. They need a break because they've been doing it 7 days a week for 60 hours a week. You can bring someone in, and that would be something that would be covered under long-term care. Hospice is typically more of an end of life for someone that's terminally ill, and adult daycare is maybe for they live with you, but you work during the day. Adult daycare would cover under those circumstances.
So just so you understand the difference, so hospice, someone's terminally ill, they're going to die, so it's full nursing care. The respite is the person who relieves the hospice because they can't just be there all the time, 24/7, all the time. So those are the difference of those two things. I know that can be confusing sometimes.
All right, so these are different levels of care under a long-term care policy. Skilled nursing, doctor has to order it. Highest cost, and it's the most medically necessary care would be skilled nursing. So that's someone that's going to basically come in and take care of a person's, their medical needs, typically in the home, but in some cases in a facility. Intermediate care is occasional nursing, rehab, maybe physical therapy, that kind of thing. It's in a facility. Custodial care is just someone that's going to come in and help you with your activities of daily living. They're going to bathe you, make sure you eat, maybe help you take your medication. And then home health care, it could be any of these levels, but it's done at home. And basically the other option is in a nursing home. So the person, you want to keep mom at home, or you want to stay at home, you don't want to go into a nursing home type facility, then you can do home health care, and it would cover any of these three categories. All right, LTC, so you have to have 12 months minimum of consecutive coverage. You must give the outline of coverage. That's a document that all the insurance company offers. Same 30-day free look period, although in this case, it's not just for seniors, it's for anybody that chooses not to keep that policy within the first 30 days. It cannot include benefits for skilled nursing that are greater than those provided for intermediate or custodial care. So what does that mean? That means that basically it has to be a level playing field in terms of where and how the coverage or the care is being given. It cannot benefit like, well, if you stay home, I'll give you more than if you go into a facility. And it has to be guaranteed renewable, which basically means it can't be canceled. Only thing that can occur is that the premium can be increased. All right, so for group health insurance, this is pretty simple. Go ahead and take a picture of this for your purposes. You can review that a bit later. All right, and we talked about this earlier on group life. It's the same with group health. With a non-contributory plan, the employer is paying 100% of the premium of the eligible employees. With a contributory plan, you have to have 75% of eligible employees participating, but the employer might pay part, and the employee might pay part, or the employee is definitely going to pay part. The employee might be paying all of it. You can also see here how it is taxed. If the employer pays the premium, the employer deducts it. So pretty simple there from the employer perspective. The benefits received by the employee for medical expenses are tax-free, so because they're not considered income. Some other information here on group health insurance. The most important one to focus here on this page is this conversion option. Typically, when an employee leaves an employer, they have 31 days to convert it to an individual plan without proof of insurability. They're still covered for that 31 days. There's no medical exam. Of course, the premium is likely to go up because any employer contribution that you are receiving is no longer going to be received, but you can convert it. So let's say you have a situation where you had some sort of ongoing treatment you were doing. And if you were to try to go qualify for your own health insurance plan, you might not because you've got this ongoing thing that you're dealing with. What this allows you to do is maintain the same coverage you have without proving insurability, without basically any change, and you're continuing to get those benefits with no lapse in coverage. This is a term you'll hear regardless of what state you're in. It's the Consolidated Omnibus Budget Reconciliation Act, or more simply, COBRA. Just think of a big snake. And basically what it is it allows you, the employee is responsible for continuing for payment of the premium, and the premium may be increased to 102% of the group premium because there's more administrative expense because now you've taken a group plan and turned it into an individual plan. You can basically receive this for an 18-month extension if you're terminated or laid off. And if it's based on death, divorce, or a child leaving home, you can get 36 months of continued coverage. And the employee, I have to basically notify as the employer. The employee has to notify within 60 days, yes, I want to opt in for this. And by the way, this is for companies that have 20 plus employers. Most states, and I say most because I'm not sure if it's all, have their own version of COBRA that covers 19 employees or less, but COBRA kicks in at 20 employees or more. Under group plans, basically this also affects employees or companies with 20 plus employees. They have to continue benefits beyond 65, even if the person gets Medicare. This just kind of gives you an idea. Federal Act for the Civil Rights Pregnancy Discrimination. Basically, women affected by pregnancy, childbirth, or medical-related conditions receive the same coverage that are provided for any medical conditions. So in other words, you cannot be discriminated against because you are pregnant. All right, Medicare, you'll have a few questions about Medicare on your test as well. Most individuals are eligible for Medicare at 65. And many employees that are working at age 65, many people are still working at age 65. So they have group and they have Medicare. If they're working, they're still working, they still have their group coverage, then what's going to happen is that Medicare is going to be secondary. So the group plan would pay first, and the Medicare is going to cover, will sort of fill in the gaps for what the group plan does not cover. And you see here, very specific for end-stage renal disease, The group plan will be the primary for the first 30 months, and after that, Medicare becomes the primary. All right, HIPAA. We're not going to go through this a lot as well, but basically HIPAA was designed basically for employee privacy. It also eliminated the pre-existing condition exclusion, so you can no longer be denied for health insurance. When the Affordable Care Act was passed, it basically eliminated the pre-existing conditions clause. There are a couple of exceptions, which you can see here. And it also made it so that if the employee has been without, basically, if there's been no gap of 63 days or more, let's say I switched from this insurance policy to this insurance policy, then the pre-existing condition exclusion goes away, and I'm fully covered from day one on my new policy. If it's been more than 63 days, then I'm subject to that 12-month exclusion again on certain policies. All right. These benefits will be covered on the test. Go ahead and snap a picture of this as well. This gives you an idea of what's going to be, some of the specific things that you'll need to know about, and this will be covered also on the final exams on your the practice tests on your pre-licensing class. All right, so open enrollment is November through January. So if you're in the process right now of enrolling in a new health plan, or you're selecting coverage now through January, you can make changes to the coverage you have. Special enrollment occurs when there's a qualifying event, a birth, a death, you leave a job, you get married, you get divorced. Things along those lines will allow you. This gives some examples down here. And from the date of the qualifying event, you have 60 days to make whatever changes you need to make or submit enrollment if you need it. And if it expires, you have to wait till the next open enrollment. So let's say it's April. May, June, you fail to submit the paperwork documentation that you need to. You're now waiting till November for that open enrollment. So it's definitely something you want to make sure that, first of all, that you're aware of and that you're getting taken care of if you need it. Go ahead and take a picture of this. This talks some of the characteristics of a group health insurance plan. All right. All right, so unpaid premium. So basically, if there's a claim during a grace period on a health insurance plan, what they're going to do is they're going to take the premium owed out of the benefit that's payable. Grace period is going to be 31 days. Same 3 to 5 year lapse rule. You have to have proof of insurability at the time you want to reinstate it. And after 45 days, let's say you submitted your paperwork and you haven't heard anything. After 45 days, it's automatic unless you've been told otherwise by the insurer. And if they review the paperwork and they say, you know what, you're actually not insurable at this time, then they'll return the premium that you submitted. Some terms that are important for health insurance. Go ahead and take a picture of this. These will be covered on the test. All right, so what the owner can do is they can assign rights, assign ownership. So they can say, I want it, if let's say I have a policy for my kids, I can assign ownership to them. I choose who the beneficiary is as the owner, and I select how the premium is paid, whether it's going to be monthly, quarterly, semi-annual, or annual. Different terms for beneficiary or types of beneficiary. Familiarize yourself with these. These are going to be important. These are going to be on the test. Changing the beneficiary, unless it's an irrevocable beneficiary, which there are certain circumstances under which a beneficiary might be considered irrevocable, and it's named as such, then it can be changed at any time. Typically, it has to be in writing. All right, if someone changes an occupation, the benefit might reduce. So if, let's say they are they're working at a front desk and then they decide to become a police officer, as an example, it might reduce their benefits. If they change to a less hazardous job, the benefit would stay the same, but the premium could go down. We covered this earlier on the misstatement of age or sex. Basically, if you say that you said you're younger than you actually are, the benefit would be lower. If you said you are older than you actually are, the benefit would be higher. And this is typically, a transposing of a number on an application. It's not typically an intentional thing that occurs. All right, LTC riders, guaranteed insurability, although the premium can be increased. Return a premium rider if there's benefit. That's going to cost more a bit. Inflation protection, somewhere between 3 and 5%. where basically it's designed to increase the benefit that's paid to match inflation. And non-forfeiture, basically, you can get a reduced paid up option or a shorter benefit period. Let's say you don't want to pay it anymore, but you also don't want to lose the benefit altogether. This would cover that. Illegal occupation. If it comes up that someone was committing a crime, or they were committing a crime in the course of whatever injury or illness or whatever occurred, and this is discovered, it could call for the insurance company to say, hey, we want that money back. Or it could mean that the claim will be denied altogether. If the person is under the influence of non-prescribed drugs or any sort of illegal narcotics, it could also result in the claim not being paid or being denied, or again, a recovery of money for services if they discover that. Do you want to say something?
No, I just think like a lot of times if there's maybe a lot lying on the application where you said, I'm a non-smoker, and then they actually were a smoker and they died because of smoking. A lot of times the insurance company won't pay out if there was, that type of stuff, but they typically will just refund the premiums to the family.
Yes. And one thing I want to stress on that, the best thing you can do for your client is make sure that the application is accurately filled out and then you're honest. If your client's a smoker and you try to get it through that they're a non-smoker, you are not helping your client and you are not helping any of the rest of the people that do what you do, because everybody's rate is going to go up under those circumstances. So the best thing you can do for your client is ask them all the questions and accurately and to the best of your knowledge and ability, answer the questions honestly on the application. All right, time payment of claims, they have to be paid immediately upon proof of the loss. So once the person submits the claim, there's proof that the loss occurred, the claim must be paid assuming that it's eligible immediately. The insurer can be sued if if the person submitted all the information in the insurance and it's an accurate, valid claim, and the insurance company says, no, we don't want to pay, you can be, the insurer can be sued under those circumstances. All right, just some basic concepts when it comes to claims. Again, this is not going to be a huge topic on the test itself, but just know that there are rules as associated with claims.
Yeah, and typically you have to prove that the person is dead, right? So a death certificate, you can't just call them like, hey, my husband's dead, send me 300 grand, right? So you got to prove that they are dead.
Take my word for it. I promise. No, they want to see the death certificate. This gives you an idea of how the premiums under certain policies are taxed. So you can take a picture of this, note this down for yourself. How things are taxed is likely to be one of the subjects on the exam. All right, Medicaid is basically government-provided, no premium health insurance for people that meet certain levels, basically poverty levels. It's based on need, not age, and you can't have a lot of assets or really any assets to qualify for it. Yeah. All right. Old age survivor disability health insurance. Basically, it's paid until the child reaches the age of 18. There's a disability benefit if they're unable to engage in any gainful employment, whether that employment exists in the person's immediate area or not. So they can't do anything. There's no job, no occupation, no anything that they're able to do. And if the disability is expected to last at least 12 months or result in death. So these are kind of some of the basic criteria for this type of policy. Go ahead and take a picture of this as well. And this as well. You've got Part A that's going to cover hospital charges for Medicare. You've got Part B that will cover the doctor. Part C. So Part A is automatic when you turn 65. Part B is not automatic, but you don't have to qualify for it. There's a premium associated with Part B, but typically that comes out of the person's Social Security payment. Part C is a Medicare Advantage, or also known as a Medicare Supplement plan. And it would also typically cover prescriptions, that kind of thing. Those are not mandatory. Those are provided by insurance companies like United Health or like Blue Cross or Anthem or one of those.
This is all the boring stuff that is kind of just memorize these things, and a lot of it will be on the test.
Here's the deal. We don't do Medicare as a company. I like to talk to people about stuff, so it might be a good thing to know about, because It's important that when you talk to your clients, they have the utmost confidence that you know what you're talking about. But unless you plan to specialize in this, again, the whole point of everything we're studying right now is to get you to the point where you can pass the test. So just know that. All right, so this is how enrollment in Medicare works. The enrollee is 65 or older and legally entitled to receive Social Security benefits. If they're under 65, but they're on Social Security disability, or they are in end-stage chronic renal kidney failure that requires either dialysis or a transplant. The monthly premium, as I said, is Part B only. Part A, there's no monthly premium. And this is the typical enrollment period, January 1st through March, and the coverage begins July 1st. So just know that if you've got clients that are approaching that, this could be a factor in whatever plan you're putting together for them. A lot of words on this chart. Go ahead and take a picture of this one. You can review this a bit later. Tells you what Medicare covers, if there's a deductible, if the patient's responsible for it, how long things are covered. So just kind of familiarize yourself with this. All right, this is the things that Medicare Part A does not cover. So note that because there will be questions on the test about these things. Again, more about what is covered by Medicare. Let's go ahead and take a picture. I'm giving you a second for that. And that is everything, Jamie.
All right. So again, this is the most boring, the most horrible part of the whole process of getting your business off the ground, this licensing stuff. Some people might be really interested in learning all of those things, but it is a grind. But I will tell you that no families get helped, including your own. You can't make any money until you pass this test. So make it a priority. Get it knocked out this week. If you don't have a test date, get your test date booked. And remember, like he gave you so much information. There's going to be bits and pieces of that on your test. So know your stuff. But the most important thing is that you head now to the exam simulators. Mm-hmm. Those 3 final practice tests at the end of all of your pre-licensing course. If you can't find it, ask your leaders, ask your senior marketing directors, your brokers to help you find it. But just start cramming. So doing multiple tests every day until you get up to that 85 plus on your test.
And don't stress yourself out. I mean, as a recovering techie nerd product guy, I will tell you that the important parts of succeeding in our business, this is a necessary step. It's not the most important thing. It's probably not even in the top 10.
Right.
But it's something you have to do in order to get paid and to be able to legally talk to people about what we do. But focus on what is important in our business. Get this part done. The good news is once you do it, you never have to do it again.
Yep. So then you'll get on to the fun stuff of helping families, again, including your own, to become on a much better financial track. So good luck, and we look forward to working with you more in the future.
And we're all rooting for you.